Good morning! As we head into the week of Monday, October 27th, 2025, the U.S. stock market is, of course, closed for its pre-session. Looking back at Friday's close, October 24th, shares of Applied Digital, ticker APLD, finished the day at $33.43. It was a relatively quiet end to a wild period, with the stock closing up just 5 cents or 0.15%. But that flatline finish masks the intense volatility under the surface. The stock traded in a wild range on Friday, from a low of $33 all the way up to $35.73 before settling back down. Now, anyone just glancing at that closing price would miss the entire story, because the expectation for APLD has been completely reset. The narrative you're hearing everywhere is that this company has secured its future, signing a monumental $5 billion AI factory lease just last week with an unnamed U.S. investment-grade hyperscaler. This deal, covering 200 megawatts of power at its new Polaris Forge 2 campus, is being touted as the ultimate validation of its pivot from a volatile crypto hosting business to a stable, long-term AI infrastructure provider. This news, on top of other massive contracts with CoreWeave and a $5 billion partnership with Macquarie Asset Management, has sent the stock on an absolute tear, up over 300% year-to-date. The expectation is that APLD is the new ground floor way to play the AI boom, a picks and shovels story that could rival the gains of NVIDIA stock. But here is the reality, and it's far more complicated than the press release. The reality is that despite this incredible news, Wall Street analysts are deeply divided, with some price targets sitting below the current stock price. The reality is that SEC filings show top insiders, including the CEO and CFO, have been selling shares. And the reality is that some of the largest, smartest hedge funds in the world dumped their entire positions in this company just a few months ago. The expectation is a simple, explosive growth story. The reality is a high-stakes, high-risk construction and finance project with deeply conflicting signals. Let's break down what is actually happening. The common belief, the one driving the incredible volume on platforms like the Robinhood app and in SoFi Invest forums, is that APLD is a straightforward bet. You build data centers, you lease them to AI companies for 15 years, and you collect predictable revenue. It's an easy-to-understand investment. This is what many conducting self-investing are banking on. They see the demand for AI, which is consuming more power than anyone predicted, and they see APLD as a key supplier of that power and space. They look at the 300% run-up and see confirmation, not caution. They believe this is just the beginning, that APLD is where Tesla stock was a decade ago. But this narrative conveniently ignores the cost and the risk of the pivot. This isn't a software company scaling up, this is a heavy industry construction company. They have to physically build these massive AI factories in North Dakota. The new $5 billion deal, for instance, is for a campus, Polaris Forge 2, that isn't even built yet. The company stated the first buildings are expected to come online in 2026 and reach full capacity in 2027. That $5 billion in revenue is spread over 15 years and is entirely dependent on APLD executing that build-out on time and on budget, all while managing rising costs for power and materials. This is where the recent stock movement becomes so fascinating. That 300% year-to-date gain isn't just new retail money. The institutional files show a battle of titans. In the second quarter, filings revealed that massive funds like D.E. Shaw and Oasis Management completely liquidated their positions, selling millions of shares. Even CoreWeave, a key customer, sold off its stake by June. These are not emotional investors. Their models clearly told them to get out. Yet, in that same period, other giants like BNP Paribas and Valorage Investment Management established massive new positions, buying millions of shares. This is not a consensus buy. This is a profound disagreement. This is the kind of whale activity that active traders using sophisticated platforms like interactive brokers live for, watching the institutional order flow. It suggests that for every fund that believes the AI story, there's another that sees the crushing debt, the execution risk, and the sky-high valuation and says, no thanks. This is a very different risk profile than, say, putting your investment help into broad market Fidelity ETFs or Fidelity mutual funds. This is the deep end of the pool for online investing. And what about those insiders? The filings from the last 6 months show a pattern of selling. The CEO, Wes Cummins, and the CFO have both sold significant blocks of stock. The bulls will tell you this is just prudent diversification, that of course you'd sell some stock after a 300% gain to secure your personal finances. The bears will ask, if this $5 billion deal is just the start and the company is truly on the verge of becoming an AI behemoth, why would you sell a single share? Why not hold on for the 10x or 20x gain? This is the kind of question that should keep anyone with an individual brokerage account up at night. This brings up a critical point about the company's financing. Comment below, are the insider sales a major red flag, or is it just smart diversification after a 300% run? I'd be very curious to see what the consensus is on that. The company is, after all, still losing money. Its most recent quarterly report, the fiscal first quarter of 2026, reported on October 9th, was a beat. They reported a loss of 3 cents per share, which was much better than the 14-cent loss analysts expected. But it was still a loss. The company is burning cash to build its future. The $5 billion partnership with Macquarie is a financing deal to fund this construction, but it's not free. This is a capital-intensive race. This is why the analyst ratings are so confusing. On one hand, you have firms like Needham and Northland Capital Markets with buy ratings and price targets at $41 and $40. They are all in on the AI transformation story. On the other hand, you have Fintel reporting an average one-year price target of just $21.53, with a high of $31. That's below where the stock is currently trading. And then you have Zacks, which rates the stock a hold. Zacks points directly to the valuation, noting its forward price-to-sales ratio is over 23, while the broader sector is around 9. They give the stock a value score of F. This is the definition of a split decision. The growth camp, probably using Robinhood stock trading to chase momentum, is at war with the value camp, which might be managed by Fidelity Wealth Management or housed in Schwab Intelligent portfolios, which would likely never touch a stock with these metrics. So let's be clear about what Applied Digital actually does. They started as a Bitcoin-focused company, Applied Blockchain, building large data centers in places with cheap power, like North Dakota, and leasing that space to crypto miners. This was a good business when Bitcoin was soaring, but it's incredibly volatile and low margin. The pivot is to repurpose this expertise and this land to build highly specialized facilities for AI and high-performance computing, or HPC. These AI data centers require much more power density and, critically, advanced liquid cooling, which APLD claims as a specialty. They aren't competing with Apple stock or Tesla stock on products. They are competing with Equinix and other data center REITs on infrastructure. Their AI factory concept is designed to be built faster and more efficiently than traditional data centers. This pivot is the entire thesis. They are moving from a low-quality, volatile revenue stream, crypto, to what they hope will be a high-quality, predictable, long-term revenue stream, AI leases. Looking forward, the bull versus bear case is crystal clear. The bulls, who are likely using the Fidelity mobile app or the SoFi trading platform to check the price every 5 minutes, see a company with 600 megawatts of AI capacity already leased out through massive multi-billion-dollar contracts. They see a company that just beat earnings estimates. They see the AI tailwind as a hurricane that will lift all boats, and APLD is one of the few pure-play boats in the water. They believe the execution risk is minimal and that the stock will be re-rated as a high-growth AI infrastructure giant, not a crypto miner. They see the $33 price as a bargain. The bears see something very different. They see a stock that is already up 300%. They see insiders selling. They see a company that is still losing money and trades at a nosebleed valuation. They see a business model that is 100% dependent on successfully executing massive construction projects over the next 3 years, all funded by complex financing deals. They worry that a single delay, a cost overrun,